聽大門新世界酒店要停止營業咯，你哋知唔知啊？
Brothers, the New World Hotel is closing down. Did you know? In the 1990s, this hotel was a landmark in Shunde, Guangdong. It has been a part of our lives for 27 years, carrying our memories. Starting from June 10th of this year, it will cease operations.
所有的客户朋友们
To all our clients and friends, the Malachite Hotel in Dongguan will fully shut down its operations on May 18, 2025. Videos have surfaced showing the closure of the Holiday Inn Qingdao Parkview in Shandong. This hotel was once the first five-star hotel in Qingdao's Chengyang district. Its closure marks the end of its storied history. Recently, China's five-star hotel industry has been facing a severe crisis. Many renowned luxury hotels have quietly shut down, been sold off, or even abandoned, with some hotels sold at rock-bottom prices. Still, no one was willing to buy.
The wave of hotel closures has arrived. At least half of the hotels will go bankrupt by 2025. This is not an exaggeration, it is happening. According to the Ministry of Culture and Tourism's data, there were 850 five-star hotels in China in 2020. But by the third quarter of 2024, only 736 remained. In less than 5 years, China has lost 114 five-star hotels.
大酒店倒闭了，东西都抢空了。
Big hotels are closing, and everything inside is being stripped. The doors have been taken down. Everything, including cabinets and toilets, have been sold off. If you came too late, you couldn't even get a door or a carpet. Everything was gone. The wave of hotel closures in China started in 2023. In December 2023, the Ritz-Carlton Tianjin Intercontinental Sanya Resort and the Guanghe-gu Tianmu Wenquan Vacation Hotel were sold as non-performing assets for a total of 2 billion yuan. Famous hotels like the Bulgari Hotel Shanghai, Sheraton Shanghai Hongkou Hotel, Fairmont Nanjing, and Westin Chongqing Liberation Square, and even the Western Beijing Chaoyang, where U.S. presidents have stayed, were either listed for sale or on the market in 2023. The hotel has room rates reaching over 30,000 yuan per night. The opposite house in Beijing has ceased operations in June 2024. Meanwhile, the Beijing Sofatel Hotel has announced its sale with an asking price of 2.8 billion yuan. Shandong Blue Ocean Hotel Group, which once owned over 80 mid to high-end hotels, had ranked among China's top 60 hotel groups. But by November 2024, it was declared bankrupt and entered restructuring. As of July 2024, its debt ratio had reached an alarming 107%. 58 of its hotel projects were auctioned off, but none attracted many buyers. At the end of 2024, the Shanghai Hotel Sheshan Oriental, less than 2 years after its rebranding, was forced into bankruptcy liquidation and began seeking new investors. Currently, Ctrip has listed the hotel as temporarily closed. The Yangzhou Xichu Greenland Berlin Hotel has been transferred and ceased operations, while the Ningbo Weili Sofitel Hotel shut down in early 2024. The first international hotel in Wenzhou, the One Home HS Art Hotel Wenzhou, was a favorite. It was sold in March 2025. The final transaction price was 45.3 million yuan, a drastic drop from its original asking price of 70.8 million yuan, with the auction failing to attract buyers twice before. In Shaoxing, Zhejiang, the first five-star luxury business hotel, the Fui Hua International Hotel, was once again auctioned off for 202 million yuan. This marked the second time the hotel had been put up for auction. The Guilin Royal Hotel Garden, a luxury five-star hotel geared towards foreign visitors, has nearly 40 years of history. It was initially auctioned for 140 million yuan, but failed to sell. It was recently relisted with a reduced price of 50 million yuan. According to media reports, the number of hotel brand changes in 2024 has nearly doubled compared to last year, with 42% of hotels being delisted, around 33 rebranded, and approximately 25% undergoing a name change. A financial report on hotel groups in 2024 reveals a general decline in net profits. Shanghai Jing Jang International Hotel's annual revenue was 14.06 billion yuan, a 4% drop compared to the previous year. BTG Home Inns, with a revenue of 7.75 billion yuan, came in fourth, with a slight 0.54% drop. The declines for large hotel chains such as Wanda Hotels and Resorts and other big brands have been staggering, with a 745% and 457% drop in revenue, respectively. Performance indicators also show a decline in 3 key operational metrics. The occupancy rate has slightly decreased for major hotel brands like Atour, Jingjiang, Home Inns, and Wanda. This has led to a noticeable trend of hotels lowering prices to maintain occupancy. The average room rate has also dropped significantly, with Wanda and Atour seeing a decline of 8.6 and 5.8 respectively. Revenue per available room, abbreviated as RevPAR, has experienced the most significant drop, with Wanda's RevPAR plummeting by 11.8%, while H World Group, Homeins, Jing, and Accor experienced declines between 3 and 7%. Once the luxury hotel industry grew rapidly alongside real estate expansion. In the early 2000s, local governments in China required developers to include five-star hotels as part of their land acquisition deals. Developers were willing to comply, as the hotel's losses were deemed acceptable as long as they could secure land for other real estate projects. This phenomenon led to an explosion of hotel openings nationwide. At the time, many local governments even included the construction of luxury hotels in their land bidding documents, often bundling it with residential construction. However, a seasoned industry expert predicts that 2025 will see an even more concentrated wave of hotel transfers. The key issue now is where to find customers for the remaining 700 five-star hotels. According to the Ministry of Culture and Tourism, in the third quarter of 2024, the average price of a five-star hotel in China was 599 yuan, a 5% year-on-year decline. The average occupancy rate has also dropped by 4%. In Beijing, the number of hotel guests in the first 10 months of 2024 was 3.93 million, a 1.33 million decrease compared to the peak year of 2018. Real estate and financial professionals, once part of the middle class, would previously choose high-end hotels for business trips and leisure. However, the collapse of the real estate sector and tightening financial policies have severely impacted the luxury hotel industry. Reports have also emerged that employees of financial institutions are facing significant pay cuts. Reuters, on January 14th of this year, revealed that the Chinese government had begun cutting overall income for employees at three major financial regulatory bodies: the Central Bank, the National Financial Regulatory Administration, and the China Securities Regulatory Commission by around 50%. On March 1st this year, the Securities Association of China released a draft of regulations which stated that if employees of securities firms engage in lifestyles of excessive luxury, their companies will face penalties. Business professor Xie Tian from the University of South Carolina explained that about 5 to 10 years ago, China experienced a surge in foreign investment, attracting numerous foreign businesses and employees who relied heavily on business hotels. However, he noted that this period of growth has ended, as the number of foreign visitors to China has significantly dropped, leading to a clear impact on the high-end hotel sector. Furthermore, Xie highlighted that China's internal economic challenges have also played a crucial role in the downturn. He pointed out that the country's anti-corruption efforts have led to a reduction in bribery, while local government budget deficits have resulted in a shortage of public funds. As a consequence, spending on both hotel stays and fine dining has sharply declined, and these issues are all interconnected. As local hotels in China face closures, international hotel giants are also bracing for tighter times. This trend has garnered much attention from industry analysts. On May 30th, according to Alibaba's asset auction platform, the Hilton Dali Resort and Spa was unable to find a buyer. It had been listed for public judicial auction on May 29th, with an estimated value of over 1 billion yuan and a starting price of 984 million yuan. Hilton Dali Resort and Spa, located south of the Liuguangchang village in Dali City, covers an area of 84,100 square meters. It was the first high-end international brand hotel to open in Dali, built at 1.8 billion yuan over 4 years and managed by Hilton Worldwide. The hotel has 375 rooms and multiple banquet halls. The auction price was extremely low, yet the results were disappointing. Reports indicate that this hotel, developed by Yunnan Shili Property Development Company Limited, was seized by the court after the company was unable to repay a loan of 2.2 billion yuan. In addition to the Hilton Dali, other Hilton properties such as the Hilton Shenyang and Hilton Changsha Riverside are also set to be auctioned in the coming month. In April, 54 hotels were put up for auction, with more than 70% failing to find buyers. Data from the Asia Accommodation Big Data Research Institute shows that between January and July of last year, 342 high-end hotels across China were auctioned, with approximately 85% failing to sell. The concentration of international hotel assets being auctioned off in China has drawn attention from industry analysts, who attribute it to the continued downturn of the real estate sector, leading to liquidity issues for hotel owners. One analyst explained, for international hotel groups like Hilton, which focuses on light asset output, these unfinished projects do not cause significant losses. However, the information creates noise in the market and can damage the brand's reputation. Brand strength, after all, is one of the core competitive advantages for these hotel groups. Recently, global hotel giants such as Marriott, Hilton, Intercontinental, Hyatt, and Wyndham released their 2024 financial reports. These reports show a trend of slower revenue and profit growth. From a core operational perspective, major hotel groups saw slight increases in RevPAR globally, particularly in Europe, the Middle East, and Africa. However, in Greater China, RevPAR generally declined. Data reveals that Marriott International's RevPAR in Greater China decreased by 2%, Hilton's by 3.1%, and Intercontinental's by 3.5%. In contrast, RevPAR growth in the Middle East, Africa, and Asia-Pacific, excluding China, exceeded 12%. This indicates that despite their global performance, these hotels are struggling in the face of China's overall economic decline. With concerns over wages and employment security, consumers are tightening their spending, leading to a decrease in domestic tourism demand. Marriott International forecasted on June 11th that its profits and fee income for 2025 will fall below Wall Street expectations, primarily due to poor performance in Greater China. According to data compiled by the London Stock Exchange Group, Marriott expects its adjusted earnings per share for the year to be between $9.82 and $10.19, lower than the analyst consensus of $10.65. Marriott continued to lead the industry in 2024 with a revenue of $25.1 billion, but its net profit fell by 22.96%. Similarly, Intercontinental Hotels also face a situation of increasing revenue without increasing profit, with its net profit dropping by 16%. Following the release of their financial reports, both companies saw their stock prices fall. On April 3rd, Marriott's stock dropped by 7.4%, Hilton's by 6.2%, Hyatt's by 7.6%, and Intercontinental by 5.2%. Over the following 3 days, the stock prices of these hotel giants continued to decline. Since the start of the year, Intercontinental stock price has fallen by 15%. Reports suggest that international hotel groups are facing increasing competition in the Chinese market. The issue of oversupply in China's hotel industry is becoming more pronounced. By the end of 2023, the total number of hotel rooms in China had increased by approximately 15% compared to 2019. Domestic hotel brands are also expanding rapidly, resulting in an oversaturated market and an era of stock competition. At the same time, there has been a rise in the sale and auction of high-end hotels and existing properties, but the transaction rate for high-value projects remains low. Against the backdrop of slowing economic growth, although hotel development costs have decreased, the outlook for consumer spending is increasingly bleak. One blogger analyzed that in the past, companies would arrange for key partners to stay in five-star hotels and entertain with expensive liquor. However, in the current economic downturn, company travel budgets have been severely slashed. A typical example is the internet giants, banks, and security firms, who once regularly stayed at five-star hotels. They're now issuing statements urging staff to avoid unnecessary business trips. Sohu Travel reports that the trend of high-end hotels lowering prices to maintain occupancy has continued since last year. The latest regulations specify that public funds cannot be used for banquets or travel under the guise of training. The government is pushing for frugal living as a standard, making those working in domestic high-end hotels increasingly anxious. The article concludes that as the government emphasizes tightening and simplifying, business trips and travel budgets, along with official reception standards, are likely to tighten even further. Industry insiders believe international hotel groups will have to speed up strategic adjustments to adapt to China's tighter times. A ByteDance company employee commented, "Now business travel is not encouraged during working hours. We try to avoid flights between 10 a.m. and 4 p.m., which is essentially a subtle push to take red-eye flights. Large companies appear to maintain stable budgets, but actually use various methods to control costs. They limit the frequency of business trips, reduce the number of accompanying staff, and optimize travel days. This has become the norm." As internet giants begin to strictly control business trip budgets, the shrinking demand for high-end business travel is an undeniable reality. On one hand, the overall budget is sharply reduced, with financial companies experiencing the most significant cuts. On the other hand, business travel compliance standards are tightening, and the review process is becoming increasingly stringent. Last year, companies like ByteDance and Tencent announced that they would upgrade their business trip systems, further tightening their reimbursement strategies. David Yang, the vice general manager of Xiamen Wutong Flipport Hotel, noted that the most noticeable shift in the hotel conference market is the reduction in client budgets. He emphasized that without adjusting prices, the hotel is at risk of losing potential events, as many clients may not even consider them for negotiations. Hospitality data company STR pointed out that business and travel demand recovery in Q1 of this year has been less optimistic, and hotel market prices are not receiving effective support. Aside from Shenzhen and Hong Kong, cities like Beijing, Shanghai, and Hangzhou have been seeing varying degrees of decline in RevPAR. With the release of new regulations, industry insiders believe that government agencies will further tighten standards for business trip accommodation and official receptions. As international hotel giants face the tightening of budgets in China, domestic hotels are likely to be left behind, struggling to survive in an increasingly challenging environment. In conclusion, both domestic and international hotels are facing a grim future in the wake of China's economic downturn. After the tightening of budgets, the next phase may be the complete disappearance of the industry from many sectors.